and welcome to Global Mantra Outlook 2014. My guest today on the show is an emerging market veteran investor, Dr. Mobius, who needs no introduction. He's Executive Chairman, Templeton Emerging Markets Group. Dr. Mobius, thanks very much for taking out the time and speaking with us. Let me begin by asking you about the Fed's recent announcement. They have begun tapering. What happens next, do you think? As an investment manager, the fact that the Fed has laid out a clear plan and has laid out the differentiation between tapering versus tightening in its forward guidance. Do you think that is comforting the markets at this point?
That's right. I don't think it's going to be a big impact. It's only when the central bank starts saying, look, we are going to start selling our assets, the bonds, the mortgages that we bought from the market, we're now going to start selling. That's when you have to start worrying, because then the system will shrink.
There was broad expectation that tapering would lead to a market sell-off and perhaps increased volatility. But the U.S. market, unlike in September, has actually been doing pretty well. It's gone into the event at record highs. It's come out of the event making fresh highs. Is the market reading tapering as good news for the economy and thereby this rally?
Yes, you're absolutely right. If you look at what's happened in the last 2 years, the U.S. market has been on a big bull run. And a bull run in the equity markets means that the economy is going to follow. So there's certainly expectation that the economy is going to be doing well. Once the economy picks up and unemployment goes down in the U.S., of course the Fed will begin to taper and to slow down. But don't forget, when that happens, there's going to be money flowing into the system, into the actual commercial system, and that will maintain the markets to continue with the bull run. The bull markets last longer than the bear markets, so we expect that to continue in this coming year, 2014.
Well, with a 27% return on the S&P 500 year-to-date, 23% on the Dow Jones, it's almost confirmed then that the U.S. is in a bull market?
Oh, yes. Since '08, you must remember the bull market started in the depths of the decline in '08. So that's when the bull market started. It's been '08, '09, '10, '11, '12, '14. I think 13 and 14 will continue to be a bull market. And by the way, emerging markets are now pulling ahead. In the last few months, emerging markets have outperformed the U.S. market. So you're going to see other markets around the world starting their own bull runs. And that'll be very important for emerging markets generally.
Right, but Dr. Mobius, the argument against tapering hinged on inflation undershooting the Fed's target. The Fed has already stated that in its statement as well, that they are worried about inflation not coming up to the 2% mark that they have laid out as a target. The same situation is in Europe as well. How big a risk do you think that is to market sentiment at this point, the risk of possible deflation?
I think a lot of it is sentiment. The Europeans have done a lot to move reform along, despite all the bad news you hear. I mean, you just take an example of Greece. Greece is doing a lot better now. You remember all the predictions that people made about the Greece leaving the European Union, leaving the euro. That has not happened. And I think Europe is definitely on the mend.
Well, Dr. Mobius, you have stated earlier that you see the value of the dollar is very high. What's your view on the greenback versus other emerging market currencies now that tapering is a done deal?
I think you'll see the dollar doing fairly well against other currencies. But you must also remember that one of the reasons for that is countries around the world have been purposefully devaluing their currencies because particularly emerging market countries had some very strong currencies. The Brazilian real was very strong, and other currencies strengthened considerably. Now, of course, they've corrected with this exit of funds as a result of the fear of tapering. But even now, many of these countries don't want their currency to get too much stronger against the US dollar. So there's sort of a competitive devaluation taking place.
Fair enough. So as we talk right now in December of 2013, what is your projection over the next 12 months? Same time next year, where do you see the US markets, the economy, especially in terms of the kind of growth numbers that are being projected, as well as the dollar?
I think the U.S. economy will be in a much better shape than it is now, number one. Number two, the dollar will be stabilized probably at this level, maybe a little stronger. And you're going to see that some of the emerging markets currencies will come up again and get stronger than the way they are now.
In one of your earlier comments around September, I think you believed that emerging markets had bottomed out. Is the worst behind for emerging markets too?
Yes, that's what we're seeing in the last few months. Emerging markets generally have performed better than the U.S. market, and that's after the first part of this year. Emerging markets were underperforming the developed markets.
But here's the thing, Dr. Mobius, if money is to chase growth and the U.S. is showing strong growth numbers, the last reported quarterly numbers came in at 3.6%, wouldn't there be a case for incremental money to go into U.S. funds versus emerging market funds?
Well, that's already happened. There's been a shift away from emerging markets. There have been flows of funds away from emerging markets, with the exception of frontier markets. Frontier markets actually have had net inflows, but emerging markets generally have had net outflows this year so far. But you must remember that as the U.S. market moves up, money flows into the U.S. market expands, then people start worrying about being overexposed to the U.S., and they will then shift back into international markets and emerging markets. So we think that's a very temporary phenomenon, particularly now that emerging markets are looking to be outperforming, people will be moving back in.
But then how does that influence what happens to global allocations? Now, emerging markets garner nearly 30% of global portfolios. Will that ratio remain the same or decrease or increase stepping into the new year as global liquidity rises, as you just pointed out to that, with more QE coming in from Japan and Europe?
Yes, but 20% actually means that they are still underweight. The emerging markets now represent about 36% of global market capitalization. So anybody who's below 30 at least is underweight. And you must remember that many institutions around the world, big pension funds and others, have no exposure at all to emerging markets. So there's a lot to be done in terms of expansion into these markets.
On that specific point, Dr. Mobius, do you think pension funds will increase allocations to emerging markets in 2014? Are your conversations suggesting that there is a broad view which is turning optimistic about EMs into the new year?
Yes, it is changing as we speak, because more and more investors are realizing they've got to be globally diversified. They can't have all their eggs in the U.S. basket or the European basket. And of course, if they're global, then they have to look at emerging markets.
Well, what's your EM strategy then? Do you think that into the new year, emerging markets will decouple, so to speak, within themselves? There are so many clusters within EMs, whether it's BRIC, whether it's MIST, frontier markets, which have done really well this year, Southeast Asia, etc. Do you think all these markets will disintegrate into individual stories, the good EMs versus the bad EMs really, and then you need to pick and choose?
Yeah, there's no question. There's been a lot of differentiation, BRIC, country funds, various like small cap funds have come up, have done quite well. So you do have this differentiation. But for the most part, the big money is going into diversified global emerging markets. That is the situation. Now there's one exception, and that is frontier. Frontier markets have expanded dramatically. 3 years ago, we had almost nothing in frontier funds. Now our frontier funds are over $3 billion in assets under management. So this has been a big area for us, and it's contributed, of course, to the overall performance of emerging markets, because in our global emerging markets funds, we're putting frontier market names. So there will continue to be diversification and segmentation in the markets. Small cap funds, for example, are doing very well now, and we have both Asian small cap and global small cap. So you can expect to see more of these specialized products, but the big money will go into the diversified global emerging markets funds.
Well, then how are you evaluating emerging markets as a value opportunity at this point?
Right now, emerging markets are still selling at a lower multiple than developed markets. So you're still finding emerging markets to be somewhat cheaper than the developed markets. Frontier markets are even cheaper than emerging markets generally. So there are lots of opportunities. And you must remember there are three very, very important macroeconomic factors. One, emerging markets are now growing at a very rapid pace, about 4 times faster than the developed countries on the average. Secondly, emerging markets have lots of foreign exchange reserves, much greater and growing compared to the developed countries. And finally, emerging markets have much lower debt in relationship to GDP. So from a ranking point of view, you're going to see emerging markets coming up the rank in terms of risk analysis. Anytime kind of company that looking at these markets will begin to rate emerging markets at a higher level than they have in the past. So the various rating agencies, Moody's, S&P, and so forth, are beginning to upgrade their ratings for emerging markets more and more.
Dr. Mobius, how big do you see global trade to be as a key driver of growth in emerging markets as well as developed markets into the coming year? Would you be more bullish on EM exporters or developed market exporters? Because the scenario is getting a bit competitive with developed markets, the US, Europe, UK also wanting their currencies to be competitive so that they can support their domestic growth with growth in exports from DMs to EMs.
I don't think there will be a disadvantage in one direction or another. And the reason is the pie, the global trading pie, is expanding at a rapid rate. And countries more and more are seeing the benefit of free trade agreements. So developed markets are exporting and importing more. Emerging markets are exporting and importing more. You know, it's a two-way street. If somebody's exporting, they have foreign exchange to import. So you're seeing a big expansion of global trade and moves to reduce barriers to trade more and more. As you know, here in Asia, they've had agreements within the ASEAN nations to reduce barriers. Japan, China is now talking with the rest of Asian countries to reduce barriers to trade and so forth. And there'll be a lot more emerging markets country trade, but the developed markets will certainly not be excluded.
So does that mean that you'll continue to be bullish on EM exporters such as Indian IT companies?
It depends on what product and what arena. For example, exports of services is a great play in India. Tata Consultancy, for example, is doing very well on the back of having to pay in India with rupee and receive dollars from their products. So it depends on where you're looking. In the garment area, the electronics area, there will be opportunities. Unfortunately, in some of these areas, the margins are very thin, so you have got to be careful of which stocks you select.
Dr. Mobius, the key risks for emerging markets are right now growth slowdown, rising inflation, and policy making. How do you view these risks for 2014 and perhaps same time next year? How different would the situation look for emerging markets?
Well, in terms of policy, things are going quite well. If you just take India as an example, if the BJP does get into power, there'll probably be very good policy moves made for India. The same thing is true of Indonesia. If they have a reform government, that would be very, very good. And you can go one country after the other, and you can see the trend towards more transparency and better governance is definitely there. We're not anywhere near where we would like to be, but we're definitely moving in the right direction. I think in terms of macroeconomic risks, they are not significant. What we have to look at, of course, is other risks. The breakout of some SARS-like disease, problems in the South China Sea, where China is trying to exert its influence, and there may be clashes between countries in Asia and the U.S. Against Japan and against China, and of course Japan will be involved. That kind of risk, and of course then you see political upheavals in various parts of the world. All of these things will play into these markets and temporarily have an impact. So we have to be very, very careful not to take a short-term view. A good example would be Thailand. A lot of people are worried about Thailand. Yes, there are political upheavals that will take place, but over the longer term, Thailand should do very well.
Since you spoke about India, just wanted your broad view. Do you think that India is decoupling within emerging markets? Is India looking stronger than other EMs in the way some key issues have been addressed in the country over the last 6 months?
I think there's a good possibility of that happening, and the market is already telling us that. The Indian market in many areas has done quite well for some stocks. So you may see that taking place next year.
What about your India portfolio then? Has it changed in this market rally? There was focus on IT and defensives. Does that remain?
No, it hasn't. We've kept our Indian holdings pretty much intact.
Now, resources and commodities are two sectors that you like in India. There's interest in stories like Sesa Goa or perhaps an integrated steel player like Tata Steel. Do you see this rally in cyclicals as a trading bounce, as a trading rally, or a secular one?
Yes, on a secular basis, I think this trend is intact. And I think you've got to keep an eye on those particular materials stocks, like the steel sector. And of course, if the BJP gets in, a lot of the projects that have been pending will be passed and will start.
Well, given the revival in Europe and the growth potential in Africa, would companies like Bharti Airtel and Tata Motors continue to make sense? Companies having organic or inorganic presence in those markets, essentially?
Yes, of course, Tata Motors is going to benefit from what's happening with Jaguar and Land Rover. And there are a number of other companies that, have investments in Europe that will ride the wave of recovery for Europe. It's not going to be a fast recovery, but it will definitely be a good foundation for the future.
Dr. Mobius, do you think India risks a ratings downgrade if the election outcome results in a hung parliament, as suggested by S&P recently?
No, I don't think so. If you know, the recent polls have put the BJP in the lead in a number of states. I don't think a rating downgrade, well, actually, a ratings downgrade may even help BJP because it will highlight the failings of the Congress Party. But I think for the mass of Indian voters, these ratings are not very salient.
But what outcome from the elections would work well with your long-term view on India?
If a strong party a reformist party gets into power and doesn't have to make too many concessions in a coalition government, that would be the best scenario.
And finally, Dr. Mobius, before we wrap up, would you be more optimistic on India into 2014, same time next year? Where do you think the Indian markets would be, as also the currency?
I think the rupee will probably be in a stronger position than it is now, given the fact that the central bank is planning to raise interest rates. So there's a good chance the rupee will get stronger, probably not significantly stronger. The market will definitely be up because we see 2014 to be a bullish year.
Dr. Mobius, thanks very much for taking out the time and speaking with us.
Thank you very much.
From the entire team at ET Now, we wish you a Merry Christmas and a very Happy New Year.
I'd like to wish everyone a Happy New Year and a Merry Christmas.
Well, thanks very much and have a great holiday season. With that, we come to the end of this edition of Global Mantra. Thanks very much for watching the show. Catch you with another special guest, same time next week. Till then, take care.